I've spent my whole career in team sports, and I definitely believe no matter how talented you think you are, no matter how successful you think you've been, it always takes a team of people to make you better. And if you're successful at building relationships, then as you get old, like I am now, you can call on these relationships you develop, and you can marry a lot of the things that you're doing in business together to truly make a synergy. And that's where I spend the majority of my time. I'm involved in about 15 different businesses, and I try to interconnect them because I think there are a lot of overlaps. That's what I really, really enjoy the most. I thought that Nike was the most hungry for Michael. They would spend the most money promoting him. Converse had the old mentality. You have to establish yourself first. So in year one, Michael and Nike outsold every American shoe company by a mile. They sold $126 million worth of shoes, and they projected to sell 3. So I was thrilled. I thought it was the right connection. Now, I would say to your investors and your colleagues, one of the things I had to learn when I was very young and impetuous is that it's always better to turn down a good deal than to make a bad deal.
Tell us, what would your spin be on that when you take Michael Jordan and you take a shoe company like Nike? What is it that you saw that very few, if anyone else, saw? What is it that you saw in that moment?
So I'm going to backtrack about 1 minute and then I'll respond. So when I started the business, I was 23 years old, and I went to work for a law firm that represented most of the major American tennis players: Arthur Ashe, Stan Smith, Marty Riessen, Gorman, and later on came to represent Jimmy Connors, Lendl, most of the major. And I didn't know anything about tennis. I really wasn't a tennis guy, but I got into it. And, as I said earlier, you have to learn what you don't know. And I learned that each business, if you will, each of these players was a business, not a not very small business. I wouldn't call it a brand, but they had a certain something that they represented to the public. If you think about this, I'm playing golf on Monday with one of your favorites, Wayne Gretzky, at Michael's club. I love Wayne Gretzky, the great one. I think I mentioned, I love Wayne. He's one of the most humble people that I know for a person who's accomplished so much. And he definitely has a certain image that you'd put with certain products. So when Michael was a rookie, it was before the age of marketing. No one in basketball had ever been marketed at all. Larry Bird, Dr. J, Magic Johnson, nobody. Magic had one national deal his first 5 years in the league. And I went to people because I was sort of bored, if I could use that. I was thrilled to be doing what I was doing. But the prevailing wisdom at the time, when you're representing athletes, you say, okay, you have Michael, in 5 years, if he's really great, you could do the kinds of things that Magic did. And I thought to myself, wow, Michael wants to do the kind of things Magic did. He should have hired Magic.
Hello, everyone.
Why is he hiring me?
It's great to see you.
Things
this is Jennifer Hunton, Chief Intelligence Officer with the Real Estate Wealth Lab. And this is our community lab today. And we chose that song, A Little Collective Soul. I saw a lot of you, Ren, you were going to jam with your guitar. Terry, I see you, you're nodding, you like that one. So A Little Collective Soul for our collective community. And also 2 other reasons. It is Keith Udi's, it's one of his favorite songs, and he is our guest today. And also because it's about shining down. And holy cow, what we're going to go through today about the Smith Maneuver and actually applying it is hopefully going to shed a lot of shine on your portfolios. So I'm just going to share my screen. So 1 moment, please. Here, sorry about that. So here we are today at our community lab. It's so delightful to have everyone here. Pop it in the chat. How are you doing? How are you feeling? You ready? Are you excited? Are you like, oh, I'm relaxing on the couch. I'm just going to see what these folks have to say. How are you feeling? Fantastic. Awesome. Lisa and Dave. That's awesome. Perfect. Super excited. Yeah, no kidding. We are going to get through some awesome data today. And by the way, this is just, again, this is our community lab. We've got Keith from Rich Mortgage Group Alliance. And we've got Vincent, our Chief Technology Officer. And what we're doing today is a bit different. It's a case study. And we're actually taking real numbers and putting them through the Smith Maneuver. For those of you who were on last week, going through the Smith Maneuver, yeah, this is going to be pretty wild. And by the way, I want you to please open up your microphones or pop it in the chat, ask questions. Nima, it's great to see you. Awesome. And let's get to know each other. Let's get to know each other's portfolios. Hey, why not? We'll go through it. So without much further ado, I just want to make sure that a couple of, I know Cape Breton, Nova Scotia, I love it. A couple of details are in your calendars. As you know, we hang out together on the 2nd, 3rd, and 4th Wednesdays of the month. And so just please, please make sure that these are in your calendars. We are at our community lab of June 15th. That's right now, that's today. And then our next event is June 22nd, next Wednesday. We're doing a research lab event. So you're gonna get your macroeconomics, what's going on in the macroeconomics and macro politics of what's going on in the US and Canada and how that applies to real estate. And then we'll be doing our market analysis on Edmonton. So if you wanna know what's happening in Edmonton, or you want to have your friends show up and check that out, please share. We'd love to have them there as well. And of course, you know how to get a hold of us. This is the disclaimer as always, just in terms of, we're going to be looking at some real numbers here today. And if you're providing it, just, go and make sure that you get an expert opinion on anything that we're talking about. And of course, Keith Udi is one of those experts, which we'll introduce in just a moment. So you're in good hands. This is being recorded. It will be, it's available to members in our portal. So just so you know. And again, all the chat rules of being polite and courteous. Please don't use it to sell, but we're now just our little community here. So this is an opportunity to get to know each other a little bit better. So without further ado, I'm going to do a little introduction of Keith. Many of you are probably familiar with him. He is an incredible person. I've actually known Keith, oh my gosh, at least 6 years now, I would say. And we met, one of the first things that we did that build relationships, and something that you need to know about Keith, you know where I'm going with this. So something about Keith and I, so he says he builds his business, which is an outstanding business. So I'll just go through that and then I'll tell you the story. How about that? So he's a mortgage associate within Rich Mortgage Group. He builds his business, which is like an incredible percentage of 80% mortgage close rate, which is huge and amazing. He builds his business based on relationships and building trust and getting to know people's goals and what they want and then how to get them. And it's and for individuals to live a life of abundance. And this is really, really important to Keith. And he's, on top of all these things, he's a mortgage broker. He's a Smith Manoeuvre certified professional, a certified financial life professional, a real estate investor, and a real estate investment advisor. And on top of all that, he's also award-winning. You've won, I can't even count how many awards you've won. He's an award-winning mortgage broker, but also a business leader and community leader. And one of his most recent awards is Beyond Business Magazine, as one of the 5 most influential business leaders to watch for in 2022. So very cool. We're delighted to have you, especially with this certified Smith Manoeuvre certified professional side of things on today. But how I got to know Keith is we were at a golf tournament. And like he said, he likes to build relationships. And at this particular golf tournament, I think it was south of Calgary. Like it was in Calgary, basically. I forget the name of the golf course. And there was mosquitoes. And like, not just a couple mosquitoes, but like swarms of mosquitoes. And so and it was raining, and I think there was thunder and lightning at some point towards the end. Obviously, we were being safe, and I had an umbrella, and we were trying to hide under the umbrella to keep clear of the rain. And then lo and behold, all of the mosquitoes swarmed up under the umbrella, and we started doing a mosquito dance. Is that right, Keith?
Absolutely. It was like the number of mosquitoes was just ridiculous. It was just great. That was at Heather Glen. And I don't golf at Heather Glen beyond about June of any given year, because the mosquitoes there just for whatever reason get really bad. And so, yeah.
And you know what? We built a great relationship around that and had some fun. And now we've been friends ever since. And Lisa and Dave, out there in Nova Scotia, like, I know you guys get black flies and mosquitoes and stuff too. This was rivaling the Maritimes for sure. So thank you so much, Keith, for being here. And like I said, we're going to be going through a case study. So I'm just going to introduce Vincent, our Chief Technology Officer at the Real Estate Wealth Lab. Hands in everything in terms of being out there. Oh, wait, I'm so sorry, Vincent. I just want to go to this page right now. For those of you, here's the information about how to follow Keith, when we go through everything, you can scan this, you can take that, we can put that link in the chat, and we'll talk about that. But I just wanted to make sure that I had that for you so that you know how to follow up with Keith, and we'll put this back up on the screen later on or in the chat. And then, sorry, Vincent, my apologies. And then in terms of Vincent sorry, go ahead, Keith.
Nope, that was Vince. Okay, we're all good.
Oh, perfect. Vincent. So Vincent has his hands in all kinds of projects, but many of you probably don't know that he's actually been on the Dragon's Den. I mean, we're talking Chief Technology Officer with flair, lots of different companies and lots of different projects. I will let you speak to those, but we're just delighted to have you at the Real Estate Wealth Lab as our Chief Technology Officer. And I got to tell you, ladies and gentlemen, there's some wild stuff that's coming to you. So thank you for being here. So Vincent, please tell a little bit more about yourself.
Oh, geez, there you go. There's a picture of my family. My sister's even on this call, which is awesome, Sangeeta. But you know what? I'm super excited for this session, Real Estate Wealth Lab. The reason I'm part of this community is we're about giving, right? So we bring in the experts. And we're using my own personal use case today on how we're going to set it up, what it's about, how we're going to set it up, and how we could help others out as well in growing portfolios. So I'm all about, property and tech, real estate, and what's coming new. And so there's tons coming in the Real Estate Wealth Lab, but this session for me is so important because it's going to help others out. So I can't wait until we get into the meat and potatoes here.
Awesome. Well, on that note, I'm going to stop sharing my screen, and I'm going to let Keith and Vincent. So imagine we're like basically just getting a consultation. This is how, Keith, you're going to do it with every single one of you on this call, privately and personally. So take it away.
Yeah. Hey, thanks, Jennifer. Thanks. I appreciate the chance to be here to go through and help you see some of the nuts and bolts of this in a few different ways. So first of all, before we get into it, I want to say that what I'm going to show you tonight is the result of having an initial conversation with Vincent. And that's number one, that's step one, is because to build these out, it takes time to do it. And we wanted to focus tonight to make sure that you can see the information without watching me type in a bunch of stuff that takes a bunch of time. So we have built out what you're going to see based on those conversations that I've already had with Vincent. But number two, if you don't know anything about the Smith Maneuver, the number one thing is you need to know the Smith Maneuver is about changing your non-tax deductible interest on your primary mortgage, on your primary home, into a tax deductible mortgage interest on your primary home. That is the whole purpose, to lower your tax burden and to actually increase your tax rebates. If you're someone who's an employee versus someone who's, if you're business yourself, we're just going to lower the tax burden. If you're an employee, you're going to get tax returns. So that is the whole main objective of the Smith Maneuver. We're going to go through 3 different scenarios. We're going to build it up. We're going to start from the bottom. We're going to build you up. We're going to start with the basic. We're going to go into just a little bit more of an advanced, and then we're going to go into kind of an accelerator model. So we're going to look at 3 different models. Vince has seen a little bit of this. He hasn't seen all of it yet. That's a little bit why he's a little excited. Him and I were looking at it a little bit yesterday. I had a couple of glitches with the calculator. And so he hasn't actually seen, now that I got those glitches fixed, he hasn't actually seen these numbers. So this is going to be a little.
Keith, is this like reality TV then?
This is reality TV. Reality TV. He has an idea, but he's not 100% sure. So it's going to be great. So we're going to go through. If you have questions along the way, I think what we're going to do is after I do each level, we'll ask if there's any questions. We'll answer any questions at that point. Then we'll go to the next model and we'll work our way through. I think that's the best way to do it. And so if I'm able to share my screen, I'm just going to make sure I can.
So from my point of view, let me explain this, because I feel like I'm on the hot seat now. Like, holy geez, this is real example of what we're going through. And so let me explain to you why I'm looking into this. So we're building our home. We're getting into now a large investment. And so one of the things that I'm looking at and saying, traditionally, I'd get a mortgage. It'll be 25 to 30 years. And like normal working class, we pay the mortgage and then we just keep going. But how, is there other ways where we can save money? Is there any ways we can grow our portfolios? And can we reduce that amortization amount, right? It's so many years. So the reason I say that is the picture you've seen of my family. These days when we work for our kids. We are setting up our family, setting up for their college funds and everything. And if there's a way to reduce the amount of years I pay on my mortgage, why not? Is there a way to grow my portfolio and get tax refunds? I'm totally interested. Jen, you know what? I'm going to bring you in for a second. You told me last call that you actually have 6 strategies, right?
Oh, yes. So for the pathway to financial freedom, I've got a huge spreadsheet, and you actually all have access to a good amount of it in your member portal, actually, on where you are today and where you want to be and what that gap needs to be in terms of number of properties. And then it was like, okay, well, that's great. That's good. Because it's, snapshot in time today, in 25 years over a normal amortization period. And I know, Terry, you've done the exercise and put it into practice. But then it's like, okay, so how do you accelerate it? And the Smith Maneuver is one of my 6 strategies for accelerating. And now we get to see it in practice.
Exactly. So perfect. So this is one of the strategies. And Keith, let's get to it. Now, this is real data.
You know what? I'd be amiss if I didn't say I've used the Smith Maneuver myself since 2005. I implemented it myself on our own, using it for real estate investing, and converted our mortgage 100% over 2 years. Yeah. And have had it since. So, and thousands of dollars in tax returns provided by the government to me because of the Smith Maneuver. So, yes.
So to qualify, I didn't know the Smith Maneuver existed, but in 2000, I implemented the same kind of strategy. And so we bought a house brand new. We implemented a strategy with a dual, and we'll talk about that. And within 7 years, we paid it off, and we actually used the funds to fund a multifamily. So there's various strategies you could use, and then it was tax deductible. But what we're doing here is from scratch. This is real life. So let's get to it, because I'm got excited about the numbers.
Yeah. And so you can already see on my screen here that we've already got some totals on the right-hand side. But one of the things, so we've gone through, we've got the employment the basic, all there is employment income, no investment income, no pension income, no rental income, no self-employed. This is just your basic income. We're saying, right now, there's no liquid financial assets or investment property assets of any kind. And this is where a lot of investors are. They've got equity in a home. They don't have other investments. They could be young, they could be old. It doesn't matter. This is where they are. They're starting out. For liabilities, come on. For liabilities, we've got right now we're sitting with no non-deductible liabilities or deductible investment loans. This is a very, basic model that we're looking is kind of where Vincent and his family are starting from. The one thing that's really important to see here, this is giving me grief. So is his tax rate. He's sitting at almost a 50% tax rate. So that's huge, because when it comes to that conversion and being able to then apply that tax rate against the interest that he's going to be converting to turn into a tax deduction, that's going to be thousands of dollars. Like, just in simplistic form, I mean, you see the total numbers over on the right, but let's just talk about in any one given year. If the interest paid in any one given year for someone in a 50% tax bracket is $10,000, and that full $10,000 is tax deductible, that's a $5,000 tax savings because of that 50% tax bracket. That's huge. Is there anybody here who wouldn't like $5,000 back from the government?
Yeah, exactly. Any kind of money from the government. So this is a basic.
Oh, Andres says, I don't want money back from the government. So I don't know. So this is the first step of building this out. Then we get into the actual property information. So the current value on the home under contract is 1.25 million. And we're looking at an 80% mortgage on that of $1 million. Based on where current interest rates are, I've used 5% in here simply because that's kind of the range that uninsurable conventional mortgages are right now on a 5-year term. We could look at a 1-year term, a 2-year term, a 3 or 4-year term variable rate. But for the sake of the calculator, it's based on fixed rates. So I use the 5% fixed rate of where they are right now. We've gone with a 30-year amortization, which is the maximum allowable amortization with an A lender. And the other reason we have to use an A lender is B lenders don't have a readvanceable product. And we're looking at a monthly payment frequency. We can change the frequency to bi-weekly and weekly, but the changes are very minimal in the overall net chunk. If you look at the net worth improvement over here, when I change it to bi-weekly and weekly, it's really not much of a change there. That makes a significant difference. We've got a mortgage payment of around $53.37 a month. And in this case, we're starting with a zero balance line of credit. But as that line of credit starts, it's going to be at a currently prime rate of 3.7% plus 0.5% for a net rate of 4.2%.
Okay, so before we move on, let's just summarize that. So we're purchasing a home for 1.25 million. We're gonna have because it's over $1 million, we have to put 80% or 20% down, and we're going to finance 80% of it. 5% is the mortgage interest rate there. You see that amortization over 30 years, perfect. And then the other component of this, besides the monthly payment or bi-monthly or bi-weekly, the other aspect of this is readvanceable line of credit. And that interest rate looks like it's 4.2%. 4.2%. Perfect. And we're starting
that will change. That will change if the prime lending rate changes.
Awesome.
So you have to be aware that there is that fluctuation within this, and that's where, if those changes happen and you've borrowed funds from the line of credit, further conversations with your mortgage broker are indeed something you should do. There's other strategies around considerations of what you do and don't do if you've borrowed large amounts in your line of credit, depending on the timeline of where interest rates are at the time.
Okay, so we got two components. Perfect. So we got two components. We got the
mortgage. We're starting with a zero balance in the line of credit right now because we're already at 80% loan to value.
Yep, perfect.
And that's the plain Jane.
Okay.
Oh, now, so I want to just actually be clear then. So this is where we've got a home, like a homeowner who's got no equity because this is a brand new purchase. So there is no equity to play around with. And they've got no other capital anywhere else. So this is just like, understood. Super basic.
Super basic. Yeah.
Okay.
But they are going to invest as they pay down their mortgage and they get those principal payments available to them in the line of credit each month. They're going to invest them into a non-registered investment portfolio. That is the key with implementing the Smith Maneuver, is the funds that you get, you can only use them to invest in non-registered investments. No TFSA, no RRSP. You already get tax benefit from those two, so you cannot use double dip, right?
Gotcha.
You double dip, you'll get caught.
And I want to add, and I'll let you go on with this, but just on that note, you can use these funds to invest in anything else. So that means you can invest in real estate, or you could invest in like an actual rental property, or you could invest in a REIT, or you could actually even invest in stocks or something, right?
Yeah.
Stocks, ETFs, mutual funds, T-bills, private equities. I've got lots of different private equities that I've used and implemented this in. Real estate down payments. You can real estate into investing into a corporation when done properly. Many different, as long as it's unregistered. That's the key. The key is unregistered. So in this case, when I talked to Vincent a little bit about this in our initial call, he figured 8% was a reasonable and achievable rate of return on the funds that he would put into his unregistered investments. Some might produce more, some might produce less, but he figured that 8% was a reasonable rate of return.
For sure. And I use that based on some of the prior guests we had, like Virtus Capital and CPI. So some of the ones we've previously had where you look at the returns, they're in the double digits, but to be conservative, I'm like, we'll just go with 8%.
Yeah. And because, all things being equal, if you're dividing it up amongst different things, I've got one of my private equities right now. They went through a tough time with the fires in California and then drought. There was drought and then fires. And so they're that one didn't produce for the last year and a half, but the other one's overproduced. So, that's where you average it out. So now we're looking at, in this case, about $986 per month that can be reinvested. And we're going to reinvest 100% of that back into these non-registered investments. So our mortgage component breakdown, when we look at this $1 million of mortgage, maximum loan to value that can be re-advanced so that you could build up to is 65% of the property value at the time that the mortgage is done. So in this case, 65% of $1,250,000 works out to $812,500. So that's the amount that the line of credit could build up to. But so the other portion, $187,500, that part cannot be converted into the line of credit. So that's why we've got these two different numbers here. And because we have no equity right now, we've got nothing available for priming the pump, for consolidation or preservation. So, but we are going to have tax refunds, and we're going to apply those tax refunds.
Sorry to interrupt, Keith. You just mentioned a bunch of prime the pump and all of these different things. So I'm just going to step back a little bit. So remember, I said like, oh, this is one of the 6 accelerators, and then what I love, and then within the Smith Maneuver itself, there are a number of other accelerators within this accelerator strategy. So
there's five other accelerators within the Smith Maneuver. But
right.
In this case, the plain Jane, we're not touching them.
Right.
The only kind of accelerator that we're using in this case, well, I guess we are using them a little bit, is we're going to put the tax refunds back into the pay down on the mortgage so it can be reinvested. So that's why we've turned that on here. If we turn that off, look at the difference that makes if you, Vincent, decide to go on vacations with your tax return rather than investing it, look at the difference it makes in your net worth improvement.
Oh, wow. That's big.
almost double.
So wait a second here, Keith. Maybe you could just
So if you decide when you get your tax returns
uh-huh.
that you're not going to apply them into your Smith Manoeuvre, you're not going to take them, pay down your mortgage, then take those funds back out and put them into your investments, okay? And then also create that additional tax deductibility portion with those funds. So if you didn't do that, this is where your net worth would be, the 702,000.
It would take a hit.
But
Yeah.
you would, but by purely saying, you know what? Yeah, when I get those tax returns, I'm not going to splurge on myself. I'm actually going to use them to focus on my retirement and my building my wealth. So we say yes, and it goes from 702 to 1.393, almost double.
That's amazing, because when what I'm also looking on the screen is the amortization improvement as well, and that also moved.
Yes, yes, that moved. You saved, instead of saving 9.10, you saved 11.5.
So has everyone seen that? Because I know we haven't done a full overview of the calculator, but this is the Smith Manoeuvre calculator. And this is where Keith has access to this tool that takes your information and then you pop it in. So everything over in that right-hand column is what we can improve upon in terms of tax improvement, amortization improvement, and obviously the fun one of net worth. Oh, they're all fun, but net worth improvement for sure.
Oh, yeah.
And then maybe you can explain, like, what's the green box and the red box down below, the net value,
so
because these are the outputs of the calculator, correct?
These are the outputs of the calculator. So when I'll go over to them in a minute, because there's one more thing down here that, because we're not using the debt swap calculator, we're not using the cash flow diversion, we're not using the cash flow dam, but we do have investment returns, because we're going to receive dividends on those investments that we selected up here at 8%. And in this case, we've said we're going to reinvest those 8% returns as well. And watch what happens on the right if you decide not to. Again, significant drop, $137,000 difference.
So basically, if I'm hearing this correctly, if we end up putting it into, let's say, a REIT, and we are getting our dividends, and then if we decide, oh, you know what, we actually, Vincent, I don't know, maybe you want to start taking more vacations to Hawaii or something, and you're like, actually, I'm not going to reinvest that money. I'm just going to use it to fund your lifestyle or something like that, or go to someplace fun with the kids. And so if that's the case, then it's only a 3-year savings on your amortization. And then what was the net worth? Do I have that correct?
Yeah. So great. Yeah. So your year saved on your amortization drops drastically. You lose like 8 years of you use 8 years of savings on the amortization. Your net worth doesn't get impacted so much, but your years of amortization gets impacted way more. So that's, yeah.
So basically what I'm doing here is I'm using the tax refunds that I'm getting because I invested the proceeds out of the line of credit into a REIT. And then the dividends I get every month, I just put it right back to the mortgage account, which now boosts up my line of credit, which I'm reinvesting. And by doing that, Keith, if you could hit the amortization improvement box there, because, yep. What you see there is I started with 30 years. I shortened my amortization to 18.5 years now, just by doing that simple move, not adding any more funds. I'm just paying my mortgage, reinvesting, the extra components that come out into a HELOC into a REIT, and then just using that same money. And now I went from a 30-year mortgage down to 18.5. So I saved 11.5 years already.
And this is with no extra money.
Yeah.
This is with somebody who has no extra money to pull from anywhere to add to their investments. Like this is for a person, like you might say, well, I'm not going to own a property that expensive. Okay, well, divide this number in half then, if you want. Divide it in half. Base it off of a $500,000 mortgage. That's still $700,000.
Yeah.
right? But the amortization impact is still going to be the same. The amortization impact will still remain the same because we're dealing with the same calculation there. But the net worth improvement.
I want to just put this in a totally different way.
Yeah,
When we're
for sure.
talking about amortization, like it's so like, I don't know. We all know what it is. We're investors and things like this. We're in real estate. But if you actually put it down into like real terms, it's like paying your house off so you don't have to pay a mortgage.
Exactly.
So all that money that you would be paying for mortgage on your private resident, primary personal residence is money now that can go to fund things or more, well, whatever. And you're living without with a home that's paid off. Like that in and of itself, like I just actually breathed a sigh of relief.
Yeah,
Did anybody else
it's
like anything
huge.
about that? Okay.
Well, I know, but I know Keith can do better, so I'm just waiting for it.
All right, let's see what's better. Okay, keep going.
So I think there's one piece
so
that we're not
then
covering.
when we come down, so if we come down here to the income required to pay off the Smith maneuver, okay? So the required payoff, the amount of income required to pay off the mortgage without the Smith maneuver is $3,827,000 for you to achieve this up here. But with it, the total before tax income you need comes down drastically because because of the accelerators that you're taking advantage of. Because your principal was $1 million, your interest in after-tax dollars was 921,000. So you really got to, because you've got to take advantage of those tax benefits.
So what you're saying there is that if I didn't do this and I did a 30-year mortgage, it would have cost me 3.8 million to pay off that mortgage that the house is valued at 1.25 that I initially purchased. Because of doing this, I have a tax improvement here.
You have a tax, so here's your tax savings because your tax improvement is 660, your tax deductions over the amortization period end up being $662,000. That's how much you kept from the, that's not how much you kept from the government. That's how much you got to deduct. 330,000 is what you kept from the government.
Oh, I see.
Because he's in a 50% tax bracket.
Ah, that's it. Okay, that makes sense.
That's right, or nearly a 50% tax bracket.
So in this scenario, if you go back down to the bottom there, instead of paying 3.8 million, if I apply the strategy, how much did I actually pay for the house I bought for 1.25 million in 18.5 years?
How much did you pay? Oh, how much did you pay in interest?
Yeah, there you go.
921,000.
Okay.
After tax dollars.
And then toggle down on the green one, the net value of the Smith maneuver. What's in
The
there?
net value of the net value of the Smith maneuver.
Okay.
In this case, because we're in the plain Jane, the net value it doesn't really change here because we're not adding any accelerators, any of the other accelerators in there.
So Keith, how come not every Canadian is doing this then? Because this is just basic.
Well, it could be because of one of their three keepers, fear, ego, or judgment, right?
Or not knowing about it.
They're afraid of investing. They're afraid of investing, and their parents have always. How many people here had their parents tell them, "What do? You buy a house, you pay it off, you live in the house. That's it. You buy your house, you pay off your mortgage, you live in the house, right?" That's the story they were told, and that's the story that many are still told by aunts, uncles, brothers, sisters, right? You don't use your home to invest. Why would you take that risk? So that's one. Two, they just don't, we don't teach very much financial level education at the high school level or at the college level, only if you go to college, university, if you only take certain courses, but even then you don't see this. So only those that really expand themselves outside of that learn it, or they have parents, siblings, or friends that introduce them to it and can open their mind. But we as Canadians also tend to be much more risk adverse.
Yeah.
Because we tend to be more conservative as a country and as a people. And so when this is something that's outside the norm, it makes people go, whoa, okay, there's got to be something criminal. This can't be true. There's got to be something criminal here. You've got to be skirting the rules here somehow. But this is fully tax CRA tested and proven. Like that was,
and it
one
almost
of the things,
seems too good to be true.
Too good to be true.
But yeah, but this is like, it's certified. My dad knows the Smith Manoeuvre's dad. Yeah, Fraser. They were friends.
Yeah.
It's a small world. Like it's really, this is really, really cool. And I just want to remind everyone, like we're taking some time to go through this calculator. Please put your chat, like, if you want to ask questions or whatever have you. We're going to go on to the, I think, other scenarios in a moment. But this calculator, in order to get access to it, this is not a real estate wealth lab calculator. This is something that I want to see that. So this is something that you do need to like graph. This is something that you'll need to connect with Keith. And I've just popped his, how to get a hold of him in the chat so that you can have a consultation with Keith to go through your numbers. So it is not in-house. So there you go. Okay, so show us what's going on here.
Yeah, so it's so critical that when people start to see just like this plain Jane basic of what can be done, and granted, you have to, that's why using a Smith Manoeuvre certified financial planner, or at least a financial planner that understands what it all means and what it's about, so that you can select the right, because it has to meet your risk, right? Because with any investment, there's risk. So you've got to make sure you understand that and that it fits you, right? Whatever you're going to invest in, that it fits your level of risk, and so that you can absorb possibility of any downside that could occur.
Exactly.
So here's the graph on, the nice little graph that shows us sort of those crossing points where things really start to make that accelerated difference. And in this case, that starts to happen around year 12, where we've got the reduced amortization and the reduced total debt crossing over with the investment growth.
Hey,
right?
Keith, can you
range
use your
here.
mouth? There you go. Perfect.
Yeah. So right here, so just before, we're almost, we're in that almost even, but as soon as we get right about there, we start to see that the deductible investment loan and the investment portfolio and the amount, say, with the reduced amortization, we're really starting to see. And it doesn't take much. You just over here at year 15, we start to see much huger changes. The changes become much, much larger in what we've got going on.
Wow.
And then right here, another crossing point. Oh, another crossing point. I can't move my mouse and keep it on that point at the same time. So you can see the box there. Year 21, look where we are.
Wow. Is everyone seeing this okay? Can you yeah?
There's no more,
give me
you've
a
got no
thumbs
more
up.
mortgage. Yeah.
Sorry, Keith. And Doug, can you see it okay?
Yeah.
Yeah? Okay, great. I just wanted to make sure that we're all on the same page, because
this
is
is the
powerful.
point where we've got no more amortization right here at that year 18, or almost not year 19. And if we look at that, look at the growth in the investment portfolio in 1 year. So 723 at year 19. And now that we're flipped, now we're 817 in year 20.
So I'm going to age myself, because this is live. What this means to me is, if I didn't do anything and I stayed and I got into the home and I just paid my mortgage and did nothing, I'd be 77, age of 77 when I pay off my mortgage. By implementing this Smith Manoeuvre and just doing that basic, I'm actually going to be 65 by the age of paying off this mortgage. just by implementing the strategy. So it's a big difference. So when you're looking at it, and personally, when I see it, I'm like, should I pay off this house by 65 or by 77? It's huge.
Wait. Okay.
Right?
Is that even a question?
I know.
Like,
So I'm
who
relating
would
it-
even ask that?
I'm sitting here thinking like, holy geez, but there's even more we can do. So I think we should skip to the next
Is
scenario.
there any questions so far to this point? Let's just on this level.
Now let's open it up.
Keith, I just have a quick question here.
Yeah.
Because you're showing the portfolio, I can't see it now because the chat just popped up in front of me, but you're showing that the portfolio is worth the 817 million, or million, I wish, $1,000, right? But
Yes.
you still, like, half of that, okay, I'm not good with numbers. A portion of that is what you still own on the line of credit, right? Because
Yes,
you have the
correct.
65. So your full amount, your portfolio itself is really not worth the 817,000.
No, it's really worth 1.7.
Where's 1.7?
So if we go over here,
I'm with you, Maureen. I'm with you, girl.
Okay.
if we go over here and we look at this is the end value. If we're looking
Okay,
at this
okay,
point
that's
here.
it there. Got it.
Okay.
So that's your total net worth, but the 817, or what, now you've changed it all on me, but the
Yes.
investment portfolio is minus that, the amount that you still have in the.
Yeah.
in the
So if you
space
look over
there?
on the far right, under the net worth improvement where I expanded
Right.
it, you see that the value of the investment portfolio at the end of amortization, so at the 30-year mark, is 2.3 million.
Right,
When you take out the deductible investment loan, which now is up to 908,000,
got it. That's the 65% loan to value that we were talking about originally.
yes. And
Okay,
in this
got it.
case, yeah. And then
Okay.
you've got the net worth improvement of the 1.393.
Got it. Thank you, Keith.
But there is certainly points along the way where your investment portfolio is not going to be worth potentially as much as you have in the debt, because you're in that conversion phase.
I'm in the building phase.
Yeah, you're in the building phase. Correct.
Okay. Thanks, Keith.
No problem.
Thanks, Maureen. Great to hear your voice.
Awesome. So let's go to the second scenario.
So the second scenario, so this is where we've taken Vincent's home, and there's a pretty good, Vincent's building a home. And so from the point where he's bought it and the point where it's going to be completed, the value is going to increase. So we haven't changed anything in the annual household income, expenses, assets, liabilities. Nothing there has changed. We've kept that the same. But where the difference is in the.
Keith, sorry, I hate to interrupt,
Yeah.
but I just want to make sure, because we did ask for questions on that last scenario.
Oh, sorry.
And so before we go ahead, I just see one came in.
Okay.
What kind of investment vehicles would you use with this approach?
Yeah, so you would want to use, in consultation with your professional financial planner that's Smith Manoeuvre certified, you would look at things such as private equities, stocks, bonds, mutual funds, ETFs. You could do Bitcoin, you could do NFTs, you could do bonds if you wanted. I'm not sure why you would, but you could. Anything that's non-registered. So the list is huge.
And
REIT,
definitely,
yeah.
so
REITs qualify under the private equity space. So,
and this is something that we actually talk a lot of some of our market leaders lab. So if you're looking for investment vehicles, or if you just even want to talk to anybody at the Real Estate Wealth Lab, please connect with us, because we can help show some of these possibilities, like everything from private equity with like CPI was just on, and Aurelio's Virtus REIT, for example, there's tons of them out there, but we also can help you evaluate them.
Yeah, down. So if you were buying Yes, in private lending as well. If you lend money out and you earn an investment, a rate of return on that, that also is included. If you use it for down payment to buy a rental, whether that be for a flip, whether it be for a BRRRR, whether it be for a buy and hold, that's another form of investing that you're expecting a rate of return. So investment to earn interest income. And so that is, those are all different vehicles that you can use.
Yeah, just not registered funds like RSPs or TFSAs, just not those.
Exactly. Yeah.
Okay, cool.
Cool.
So this example, before we just start, the last one was my primary home without equity. The difference on this one is this one scenario is primary home with equity. So there's a difference there.
So this is the primary home. And in this case, we've said that the home looks like it could be worth $200,000 more than what it was paid for. So at the time of being able to refinance and capture that increased value, we would still be looking at a mortgage balance of $1 million. But now we're going to be building in a readvanceable line of credit, and we're going to show this on the next page, to make up that 80%, which in this case would be $160,000 because of 80% loan to value. So when we come over here into our investment assumptions, now we've still got the 8% return. We're still going to reinvest 100% of that, but the total mortgage borrowing limit we now get to use is 1.16 million. So we've just added 160,000 onto here, which comes down here. In the previous one, this was 0. Now we've got 160,000 available for one of the accelerators. And in this case, because we're not consolidating or preserving debt or anything like that, we're going to prime the pump.
Oh, so if I get this, then basically in the last example, because there was no equity, like Maureen reiterated also, there's 65% loan to value for the line of credit, but you can't access anything more because there's no equity in the property. So
Exactly.
in this one, because there's equity, you're able to access that delta, bringing it up to the 80%. I see.
Exactly.
See what
wow.
happened?
Woo!
What happened on this
Right.
one, Jen? I signed the contract for 1.25 million, right? And the market's gone crazy. The appraisal we did, the evaluations came between 1.4 and 1.6 million already, and the house is not even building.
So you're gonna get money before it's even built,
Yeah.
and access to. Oh my gosh, that's exciting! That's
And
exciting.
so what with Keith done here is he said, okay, now that we've got our appraisal, this is coming in, we can already build in that equity portion.
We start to look at what can this look like once the house is built.
Yeah.
Because we can't essentially, we can't put a readvanceable product in place until it's done being built. So he's going to have to wait a little bit. But
Well,
this
so
is
and then
what
this
we're
is
gonna build
all the more reason to talk to you, Keith, because like that's strategy on strategy, because you're dealing with, okay, so we do this now, but now you're going to have to get him into a mortgage that very quickly could be renewed or whatever have you, so that he could get the readvanceable and get at it.
Exactly.
Exactly.
I like it.
The key to this is there's a lot of planning that goes to it, right? So when Keith's saying there's consultation we got to do to set you up perfectly and you need a certified person to do it, he's not kidding. There's a lot we need to do, but once it's set up, it's worth going to it because I'm saving years and years off of this. So just let's keep going here.
Yeah. So in this case, we are reinvesting the funds, the tax returns into the Smith Manoeuvre with the conversion. Again, if we take it out, watch these numbers on the right. We take it out. Look what happens. 1.5 million lost. Almost 1.6.
Oh, right.
Oh, wow.
And the amortization.
We're looking at the net worth.
Yeah.
And then the amortization, it doesn't seem to change that much on the
about
amortization.
2 years. The amortization only changes about 2 years in this, but the net worth is huge. Almost 1.6 million. None of the debt swap doesn't apply, the cash flow, but we are doing the dividend reinvestment plan, where we're going to reinvest that 8% return. But now we get to add the prime the pump. So we're going to prime the pump with that full $160,000, which means it's going to go into that 8% investment portfolio right
Like a
away.
REIT. Yeah.
Like a REIT or whatever it happens to be, whatever you choose. And that actually, there's also the $560 that has to be covered on that $160,000. There's a payment that has to be covered. So we're going to also use that as a repayment against the mortgage, and then subsequently we borrow it to be able to further service the incremental interest. So we're accelerating on accelerating. So we're just building, we're building layers on layers. We're building that Black Forest cake.
Oh my gosh, I haven't had a Black Forest cake in eons. That used to be my favorite.
Don't go to
I'm gluten-free and dairy-free. There's a bakery in Calgary here that makes a gluten-free and dairy-free Black Forest cake. You can't tell the difference. Oh my God. Now I'm going to have to order one for this weekend. And here's Jen's favorite part, the graph.
So let's just, before we go there, Carlos had a question.
Okay.
Thanks. Shall I read it? Okay.
Yeah.
The question. Thanks for pointing that out. I was so busy looking at the graph. The tax refund and reinvestment, is that just the Smith portion or the whole refund? Say you had other deductions.
This is just based on the Smith refund portion. If you had other deductions that expanded upon it, spectacular. You can choose whether you use that to accelerate further or not.
And that would be something that your accountant would help with, correct?
Yeah, that's something your accountant would help with. Yeah, right.
Okay.
Absolutely.
So
Absolutely.
one of the things that I know we're getting excited about the graph, but what got me excited right now is when I did the math, I went from 77 years to 65 in the last example, and this one takes me down to 59 years. The house will be paid off by 59.
Yeah.
So like that's massive, right? So we went from the 70s, 60s, and now we made it into the 50s.
I'm excited for you, Vincent.
And Maureen,
And Isabella.
yes, I see Maureen has a question there. Maureen, yes, you do have to make payments on the non-mortgage portion. So the HELOC, there will be interest-only payments that you have to make. But this is where, depending on the type of mortgage product that you're set up with, there is a way to use the line of credit to pay for the line of credit interest, because you're using line of credit to pay for line of credit interest that was used for investment. So if you are someone who's cash flow tight in the consideration of everything, there's things like that. But then there's also the consideration, remember how, I'm just going to go back one page, and you might be someone who says, well, I don't want to do that. I don't want to borrow to pay on the borrowed funds. That's where the dividend reinvestment plan accelerator, this is where we could say, okay, well, that's fine. Let's say out of that 8%, you're going to keep 50% of it, and we're only going to reinvest 4%.
And the other 4% goes to pay the HELOC, you're saying?
And the other 4% you're going to use to pay the additional interest cost on the HELOC. Not a huge difference, right? Went from 3,599 to 3,515. So a small difference. If that's what makes it more comfortable for someone, then that's the way you do it. You're giving up a little. You might give up a little here, but you might gain a lot here.
Yeah, peace of mind. I get it.
Not everybody has a different way that it feels and works for them, and that's okay.
Okay.
I just talked to a client today, and this is the space that she was in as we were going through this, was about, well, what about that payment that has to be made on the HELOC? And that's where we talk about, well, depending on the type of investment you choose, whether it's monthly, semi-quarterly, semi-annually, whatever, you do need to, if you want to take those rates of those returns you get and use them to make the payments, there's going to be a time when you have to make the payment yourself. So if you're in a monthly, it might be for the first month or two. If it's quarterly, it might be for the first quarter. And then when you get those returns, you can say, okay, well, I'm going to keep this to help make the interest payments. And then the next quarter, maybe that one you don't, or however you do that. So that's where, yeah, eventually you have to pay the piper. Eventually you have to pay the piper. Absolutely. But you get to build wealth on borrowed money in the meantime.
There's good debt and there's bad debt, right?
Yes.
And that's how
This
we
is
have
good
to see
debt.
it, right?
So can I ask a different question about
Yeah.
this? Is it like in terms of paying the piper, kind of, so to be clear, so in some ways we get this net worth improvement of 3.5, okay, or 3.6 million, and we've saved 17.7 years on our amortization. But if I understand that paying the piper, that 3.6 would have to go, some of that would have to go back to pay off the mortgage and the thing and the line of credit.
Actually, if we look here on the right side of the screen, I just opened up that window for the net worth improvement.
Thank you.
The value of the portfolio would actually be 4.676. You could cash in $1,076,000 to pay off the debt that you currently have, and you're left with 3.6.
So I'm left with 3.6 and my house paid off?
Yes.
Yes.
What?
I know. That's what I'm
You
saying.
can choose. You can leave. You can have 4.6. You can have 4.676 and keep the debt and continue to get the tax deductions
I see.
and do whatever and do it. Or you could say, okay, Mr. Portfolio Manager, I need 1.1 million. I want to pay off I'm going to pay off what I owe on the house. And I'm going to be left with 3.6, which is still going to produce me 8% a year. Would you be happy with $280,000 a year?
Yeah. No kidding. Very cool. So hopefully, Maureen, that helps also answer that question of like, yes, so we pay the piper, but we've created enough, like a substantial amount of delta that we can pay it and still continue or continue this on, whatever. But
Yeah, absolutely.
Yeah.
So
And
it's
this is where this graph comes in
yeah.
to play here when we start to look at, okay, what's the investment portfolio worth versus the debt that we've still held. And so for some people, they may not be willing to stretch it all the way to the 30-year for this, right? Somebody might say, well, when I've got $1 million, if I've got $1 million difference, I'm going to be happy. So somewhere around, I guess, year 21, you'd have that $1 million of difference between what you owe and what your investment portfolio is worth. You could do it at that point if that's where you wanted to pay off the good debt.
I just know, Keith, that I'm looking at buying a place I intend to retire to. I'm going to be talking to somebody about a Smith Maneuver, quite possibly you.
Exactly.
Fantastic.
Drop the contact in the.
I'll do that. Go ahead.
Yeah. So,
I'll make
so
it
if you
easy,
look at
Maureen.
if you look at this, Keith, can you just hit the amortization improvement?
You bet.
17.5.
Absolutely.
You
So
could
look
kind
at
of tell
this.
what I'm. Yeah. See. So in 12 years. In 12 years, a 30-year mortgage has gone down to 12 years and it's paid off. And I have a investment portfolio where I'm getting 8% interest on the money I invested. And that's every month I get dividends paying to me. So the way I'm looking at this is, if I was to go get an RSP, I have to go to a bank. I'm becoming my own bank.
Yes.
That's basically what I'm doing. And I'm using good debt to make money off of it. And if you're a bank, the bank wants you in for 30 years. They want to make that money off of you, but they're not going to tell you how to do this because they don't make money off of it. So this is why we're bringing this, right? This is why this is so important. It's a bit complicated, but if we break it down like this, it totally makes sense.
And you can make money off the government.
Yeah. I'm getting my returns.
You're getting your returns. So you're making money off the government.
Yeah. So what's different here is, you know what? We have to do this in Canada because in the States, their mortgage interest is tax deductible. Like they could deduct that tax. In Canada, we can't. So we have to implement strategies like this. Investments are tax deductible. So this is how this works.
Yeah.
Yeah,
And
and so here's
actually-
one, and here's
Sorry.
one other important piece of this is that in the US, even if they refinance, they change their tax deductibility of their mortgage. In Canada, refinancing is the way we put this into play for a lot of people, because a lot of people buy with 5%, 10% down. And that's how. Now, there are some cases, now, you know what, I'm gonna, just at this point, because we're gonna transition to the next stages. There's people who bought property in the last, I'm gonna say 2019, 2020, 2021. And they bought them with 5, 10% down. And they paid the CMHC fee, but now their value has gone up 20, 30, 40%, depending on the city you're in. And they're going, well, now I'm sitting on this equity, but I've got an interest rate of 1.89%. If I have to refinance right now, I'm going to be paying 4.89% on a 5-year, 4.29 on a 2-year, or a variable rate of prime minus only 0.4. Like, that's huge. So sometimes we have to talk about, okay, how could we hybrid something for someone to help bridge them so they can start at least, but not feel like they're giving up the farm based on their 1.59% mortgage. So there's things we can do sometimes that we've got to hybrid things to at least get them to be able to start, but it's not going to be a full Smith maneuver at that point. But I'd rather see people get started than sit on the sidelines and wait.
So just to summarize, at this point in the game here, I'll be 59 when I retire. My house is paid off, and my net worth is, after paying everything off, is 3.6 million. And just in this, not anything else I'm doing, just here.
Correct.
Okay.
Yeah. So this is just with equity. Now, my friend Vincent here, he happens to own a little bit of real estate.
Yeah.
And so we are going to.
Things are looking good, man.
I know.
So we're going to take a little look at what it looks like with Vincent and his real estate. So in this case, we've got to add a couple of things because of the real estate. The annual employment income doesn't change. However, we've got some annual rental income that we've now got to build into the formula. And we've got to put in the annual rental expenses. This is based on the most recent information that I got from Vincent.
So I just want to qualify this for folks on the call. So all we're doing here is, I got 3 condos, and we're putting the 3 condos inside of this plan. So it's none of my multifamily or any of the other investments I have, just strictly the house I'm buying. And I have 3 condos. We're going to put the 3 condos in here, and that's the numbers that you're seeing represented.
Yeah.
And
And so you can
Vincent,
see-
sorry, Keith,
Go
just
ahead,
a second. Yeah, so Vincent, is the reason, why did you choose not to have the multifamily? Is that because they're in corporations and your condos are in your personal name?
Absolutely. So it gets a little more complicated to do commercial, and that's a whole different strategy. But for this, to keep it simple, and this is more likely for other users as well on this call. This is something I'm comfortable doing right away. The complex scenario with multifamily and apartment buildings, I want to save that for later. And that's a different improvement. This in itself is huge. So
Awesome.
yeah.
Okay.
Yeah, this is more. Vince and I talked about this in detail, that and in doing this for the lab, that this is more of a reality for the majority of people, because this is based on owning 3 condos, not a huge amount of, we're not talking a huge amount of rent here. So this could even be one property. This could be, one property with $2,500 a month in rent, $2,600 a month in rent. This is a reality, right? You own 1 rental property, you're getting $2,600 a month in rent. This is the possibility, right? In this case, he owns 3, but it's not about 3. It's about how much annual rental income are you pulling in. And then you've got the annual rental expenses, which in this case, the cash flow is about $3,000 a year. But so down here, our total gross annual income works out, including the rents, $272, and we've got expenses of $29. So our net income is up at $243.
So these are not high cash flowing properties. These are just run of the mill, just simple condos. There's 3 of them. They're small. We're just
Yeah.
putting it inside this portfolio.
Yeah, perfect. Carrie's saying in the US, the sale of their personal house triggers taxable income. With the Smith Maneuver, the payments are tax deductible and the sale is not taxable.
That's correct, because it's our primary residence.
Okay.
But guess what? If you have a Smith Maneuver mortgage in place and you sell your home and you happen to incur costs or penalties to pay out that Smith Maneuver mortgage, there's the possibility of deducting all or a portion of those expenses. Because
Yeah,
it-
that was a big wow.
more intense. That's a bit
Right,
more
Carrie? I read lips. Awesome. And there's another question. Who's a candidate for this? How much debt to equity do you need for the HELOC?
So if you have 20% equity in your home, you are eligible to have this looked at. Or if you own, in some cases, I've had some clients where they were just over, they had like 17, 18% equity in the home. And they were like, well, we want to improve this. We'll pay the mortgage down. We'll take advantage of our prepayment privilege. We'll pay the mortgage down. So we're at the 20% equity. Once we get the appraisal done, we'll pay it down so that we can implement this right away. So some of my clients have done that as well.
Okay, cool.
So in this case, we've added the investment. His condos are worth $540,000. So for anybody else, this could be one single suite at home or a half duplex, depending on the city.
We're
Would not put in any emergency
400
funds.
square feet in downtown Vancouver.
Yeah, exactly. 400 square feet.
Whatever
downtown
it is.
Vancouver, yeah, right?
Just a property. Exactly.
Yeah, exactly. Right. It's a matchbox in Vancouver and Toronto.
There you go.
Liabilities, the combined, that should not be there. The combined liabilities here are $309,500 on those condos. And the tax rate, it's stayed the same, consistent.
Half my money goes to government. Yep.
But the mortgage information, well, we are dealing with the higher value on the home because we're using this based on the fact that the property value is increased. So we've got that mortgage at $1 million, the 5% interest, the 30-year amortization. These have not changed from the previous ones, but we do have the readvanceable line of credit that's going to show up over here in our investment assumptions. So we still got the 8%. We're going to invest all of our monthly prime principal pay down. And I want to clarify something for you on the principal pay down. This doesn't look like much relative to the mortgage payment. When Robinson set up this calculator, he set it up based on the Manulife One model and where they separate into sub accounts. And him and I talked about this today. He's got to get his web guy to see about being able for us to be able to select a different model than that to show people, because not everybody, we don't put all clients in the Manulife One. It doesn't work for some people for various reasons. Some people it is the one. And so this further could be accelerated by using a different lender where they don't break it out that same way, where you could access more of the principal pay down each month by using a different lender. So this amount could be $2,300 a month, which would further accelerate this, just so you know.
Awesome.
And in this case, our total mortgage borrowing debt that we can get is 1.16 million, which is 80% of the 1.45.
Yeah.
We've got the same breakdown as we had on the mortgage components from before. We're going to apply the tax refunds. And again, let's look at what happens if we don't. It's only a year difference this time if we don't apply the tax refunds, because we have the cash flow down accelerator. So in this case, The cash flow down accelerator is where you take your rents from your rental properties, you apply them to your principal mortgage, primary home mortgage, and then you draw the funds out from that it pays down on the HELOC. You draw the funds out from the HELOC to use to pay your rental property expenses, which is the intent to earn investment income from your rental property. Now you've converted $2,426 extra in that given month. And this is where the Manulife One helps you excel over some of the other products out there. So there's some give and take that can happen in what you can gain in one, you might give up in another, but that's where we talk about the products with the clients.
So can you go through that
yeah,
again?
Go ahead.
Yeah.
Well, actually, I think I'm going to try.
Okay, go ahead.
So how I understand it is that we take Vincent's 3 condos and how much rent they're making per year. Oh, per month?
Per month, yeah.
Per month.
Per month. Okay, great. And then you put that into you're paying down your mortgage. Then you take your mortgage, you pay down your mortgage, and then you have more line of credit available. So you actually use that, and then you invest that.
You go pay.
You put that back into the property to pay for the expenses.
Oh, right. Back into the rental property. Got it.
You need to pay the expenses. The expenses
so you're just
are coming
doing this
out.
sort of like cycling of it. Okay, I get that. A quick question. Now I'm going, is that like a lot of effort to have that? Like, do you have these set up like automatic payments or like just automatic cycling through?
Yeah.
Well, it might take a couple of transactions, extra transactions for you in a month to make it happen. But what's your net worth?
Oh yeah, worth to you.
Worth to you, right?
Yeah. Absolutely. Mark is asking a couple of questions here. That's assuming the available line of credit is at the same rate, correct? Most are set up.
No, we built that in that the readvancing line of credit is at a different rate. That's built into the formula here.
Yeah. Okay, and then there's another question, Maureen. All 3 properties in a blanket mortgage? Maureen? No, I don't think so.
No, his mortgages, they're not in a blanket mortgage. No, they're single separate mortgages, but for the sake of the calculator, we build them in as the total. I have to do that calculation. I have to go in and do that calculation and then put them in as a total. So Mark also asked, they are set up with a revolving portion and a term portion in the case where there's extra equity. However, there is a case to be made for when you pull out the additional equity up front, like that 160,000, do you pull it out from the revolving line of credit, or do you build it into the mortgage that you draw from the lender into the term right from the start? It can still be tax deductible, that 160,000. It just involves a additional calculation at the time of doing your taxes to figure out how much of the interest is tax deductible. So to break it down a little bit further for you on that.
And wait, Keith, sorry, because Mark wanted to ask a question and actually talk. So if you want to just unmute Mark.
I think that's what he's answering essentially. But I think at the end, I'm probably gonna have the same question. So I'm gonna ask anyway, just to make sure that the full thing is covered, but I think he was answering it. So essentially, he's talking about the Manoeuvre One thing that was invented in the early 80s. Was an interesting thing. They're the first one to do that. The thing is that now most products are separated between term and revolving portion. So every time I pay down my term, my revolving I can borrow more here. The problem is every time the interest rate here is about 1 or 2% higher than the interest rate here. So if we use the Manoeuvre concept of putting all of our money on the house because it raised the revolving, but then borrowing here to pay all the bills, well, every time I'm borrow to pay a bill, now I'm borrowing at 2% more. So I'm curious to see what the savings really are.
Yeah, but the difference is that what you borrowed at the higher rate is 100% tax deductible. So then that also helps you on your tax deductible interest side. So, however, with clients, when I have the discussion with them about that, in this case, the 160,000, we discussed, do you want to do it? Is your intent to take that 160,000 and invest it soon after, within 6 months or a year? Or do you plan to have it sit there and wait until you find the right investment, which might be maybe a year or more? Most of my investor clients are like, well, no, I plan to use it within 6 months to a year. So then I say, well, okay. I show them the calculation difference. And you know what? We'll do this after. I'm going to explain it, but then we'll remind me to do a calculator to show you. We do the calculation of the difference of what the cost of that 160,000 is in the line of credit over a period of 5 years versus an amortized mortgage over 5 years or longer. Because when you invest, the intent generally is not to repay that amount. You're going to repay over on the mortgage. So you're going to carry that debt longer. So the long-term cost of debt, that interest, becomes a part of the calculation. So the simple if you build it into the term mortgage at the time of the refinance, in this case, it would be 160,000. You divide it by the mortgage balance at the end of the year. So 160 divided by 1.16, which was the mortgage balance at the start of the year, and you get a percentage. In this case, it's about 10%. You get your interest that you paid in the year. Let's say it's $10,000. 10% of 10,000 means that you would have $1,000 of deductible interest, right? Or it might, if it was 100,000, it'd be $10,000 of deductible interest. That's how you can build it in, but still calculate it. But as long as you keep the tracking, when you got that check for $160,000 from the lawyer, it needs to go into your Smith Manoeuvre savings account, because that triggers the immediate tax deductibility of the interest on those funds. Because what's the intent of a high interest savings account? To earn investment income. And that's what triggers it. So you deposit that there, not into your checking account. Then from the savings account, that's where you distribute it to your other investments.
Awesome.
But in this case,
is that more clarified, or did that answer your question?
Does that help you, Mark?
Help?
Yeah, it does. I understand what you're saying.
Yeah. And for the sake of this calculator, though, it's built off of the 160,000 extra being in the line of credit, and then also the monthly addition is also based on that going in the line of credit, not being amortized. But there's other things that could accelerate this by doing some other things. But a lot of people are, like Jen said, I don't want to have to do a whole bunch of extra transactions and figure it out. I just want to be able to kind of set it and forget it as much as I can. Ron Popeil, set it and forget it.
I like it.
All right. Cool. So in this case, we're going to do the cash flow DAM accelerator. And we've got the dividend reinvestment plan of 8%. And we've got the prime the pump. So we've implemented 3 of the 5 strategies here.
Accelerators. Strategies.
Accelerators. Yeah. So the accelerator strategies. Sorry.
So 3 of 5. Okay.
And so now we're looking at a net worth improvement of 4.2 million and an amortization short improvement of almost 21 years.
So I'm paying off my mortgage in 9 years.
How old will you be then, Vincent?
I know, I did the math.
You've done the math for all of them. So 56.
56.
It's almost freedom 55, man.
I know,
that's
almost.
Awesome. We didn't even plan that.
It could potentially be freedom 55.
Could be, but look at it, right? So simple strategies. The first one, it was 70. If I don't do nothing, just a regular mortgage at the bank, I'm 77 when I pay it off. If I just do the basic one with no equity, it was 65. If I had equity, which I already do, it dropped it to 59. And if I just add these condos, simple condos in, we're real estate investors, it's down to 56. 9 years.
Yeah.
Wow.
Tell me, there's a lot I could do with the other 21 years with my family when I'm not paying a mortgage, right? So it's huge.
Game changer.
and you've got a portfolio that's worth 5.3. And if you choose to cash in some and pay out the debt that you built up on the home with the conversion, you
Yep.
still have 4.2 million left.
Yeah. So 56. So in 9 years, the house is paid off, right? The 1.25 million house, or 1.45 million. It's already from there. It's already increased in value, anyways. It's paid off, and you have 4.2 million in net worth improvement.
Wait until
I
show you
have a
this.
different question for you, Keith, because my wheels are turning in all of this, and as a part of the Smith Manoeuvre professional, like the certification, are there others who on the team? So you have to have mortgage broker. Do you have like an accountant on the team who knows this? So it's or do you explain, like, would you have a conversation with someone's accountant to kind of explain something here, or is anything else required?
Yeah, so I think Robinson touched on this last week. The list of Smith Manoeuvre certified professionals, whether they be accountants, realtors, mortgage brokers, is available on the Smith Manoeuvre website. I certainly, know plethora of them myself, and those that I know clients have worked with, or I've, in some cases that I've worked with. So I know who those are, and can refer clients to them as well, so that they get access to people who have this.
Okay.
And understand it. There are accountants who don't get it, and they say, well, you can't do it.
Right.
You can't-
Perfect.
you
Thank
can't do
you.
this.
So you
Yeah.
want to have your power team like up to snuff here
Yes.
and or part of it. And so I just popped in the chat. If you want to go to the website to look for the other that list of professionals, I'll put the link to you, Keith, back in here.
Yeah.
And Maureen's just reminding us that, oh, right, this is only based on an 8% return, which is of course possible
Sure.
to get different,
Yeah.
especially with, I know, private lending. Yeah. So, awesome.
Exactly.
Keith, you're currently showing, so you're showing multiple
I'm
screens
showing
here.
all three. So now that we're at
Okay.
the end, I'm showing all three.
Wow.
This is number one here on top, 11 and a half years saved, net worth 1.393. Number two, I need to, just give me a second. I need to just shrink that so that it shows up properly.
Got it.
3.599. And number three, 4.2 with a little bit of cash down. Really what could be the equivalent to one property for many.
Yeah.
Wow.
That's just, $32,000 worth of cash flow, of gross cash flow per year, not net, but gross.
Right.
Makes a difference of $600,000 in the net worth improvement.
Wow.
Yeah.
What I want, Vincent, is like, okay, this is the 65 plan, the 59 plan, and the 56 plan. That's really what it is. It's pretty cool. Oh my gosh. Well, thank you so much for sharing that. Other questions from the floor? Or do you...
Questions, and I'm gonna pull up my calculator here because I want to show you this one calculation I promised. I promised to show you this calculation for the one thing that I do with clients. It relates back to Mark's question. And thank you, Mark, for asking that question, because it triggered me to do this for you. If we take that 160,000 and it's at 4.20% right now, but it's interest only, and we're going to go 5 years. So that's your interest only payment on that per month. But if we take that same 160,000 and we did it right now at, let's go with a variable rate of prime minus 0.5%. So that's 3.2%, because these are both really variable. So we're capturing this 1% gap for the 5 years, no matter what. Because if this moves, this moves. remove the same. Based on a 30-year amortization, I'm going to put that to 0. I'm going to put that to 5. So it's a $9,000. You could have a $9,000 savings in interest by putting it into the term portion at the beginning versus keeping it in the line of credit. So significant, certainly, depending on a person's point of view. Some people might say, it's only $9,000. I'd rather have the lower $140, $135 smaller payment. I'd rather have that. Other people say, you know what? No, it's $9,000. I'd rather have the $9,000 than the bank, even though it's going to be tax deductible. I'd rather have that. So that's the importance of that calculation. And I do that with many clients when we go through this because of that conversation. What do you plan to do with the $160,000? And honestly, the bank, the underwriter is going to ask me that. They're going to ask me, what is the client going to do with the money? And my response in the majority of cases is they're implementing the Smith Maneuver. They're going to put it into unregistered investments.
Yeah.
Perfect.
Wow. Well, thank you for walking us through that. I'm happy.
Now
I didn't see all the results until you showed me.
I know. Yeah, you didn't know this because I had to do some tweaks. Now, Jennifer, if you want me to, I've got a link to book excerpts for the Smith Maneuver book that I can share a link to.
I'm sure.
Okay. Anybody who wants it, there it is. It's just some excerpts from the book to give you an introduction to the Smith Maneuver.
Awesome.
Well, thank you. That's a huge bonus gift. That's very cool. I'm opening it up.
Maureen, yes.
The brain is
absolutely.
working on overload. You could do the book, or you could actually just call Keith or go to this link, and that's how I'm like, Keith, we'll be talking. I probably won't be reading this one.
You know what? But the excerpt, but that's what's great is the excerpt is not this great big long. It's really broken out to just give you, after we've gone through all this and there's so much, it's a nice little just smaller summary of the basics of the stuff we've talked about.
And by the way, thank you. I also just want to mention, no disrespect to Robinson. It's an amazing book. Go get it 100%. I was just thinking, I want to get this implemented so soon that I don't want to wait for the time frame to go through it. So that's just me at this point. So thanks for
and everybody's at a different space, right? Some people are like, no, you know what? I'm going to read the book first, then we'll talk about it. And some people, that's where they are. And then when we have the conversation, they're like, oh, okay. Well, I don't need to read all of the book then because I'm just starting with the plain Jane, right? I'm just at the plain Jane mode. I don't need to worry about half of the book because I'm not going to do any of the accelerators really at this point, other than make the investments and reinvest my drip. Yeah. And my tax.
And again, just a reminder, the plain Jane was that homeowner with no equity.
Maureen has a question.
Hey, Maureen.
There, my mute button wasn't working. So this is on the personal, me trying to figure out if I can actually do this. So right now, my plan is I have my primary residence here. I intend to buy a retirement home somewhere else and keeping this house as a rental. But the down payment for the house will be based on the HELOC that I have because I have a Manulife One. So can I use a Smith Maneuver on the second home if the down payment is coming from a line of credit?
You're going to take the down payment from property one primary and use it as a down payment to buy property two as a secondary.
Yes.
So yes, you could put a readvanceable mortgage on the secondary and begin to implement it on the secondary.
Okay.
As well as on the primary. Honestly, once you took that money, it's a matter of accounting and keeping track, but you could essentially implement it on both.
Great. So now my brain really is going to be thinking overtime. I thought that was going to be my out, that I could get a good night's sleep without having all this going through my head. Thanks, Keith. It's a good workout, though.
That's hilarious.
Yeah, that's right.
Do we got any other questions? Doesn't look like it. I'm so super excited. Thank you, Keith, for walking us through this. I'm definitely a happy camper that we're implementing this, and we got to showcase to everybody the power of leverage and strategies, right? Especially with Smith Manoeuvre. So yeah.
And it was, go ahead, Jennifer.
Oh, and I was just gonna say, and with smart people on your team, you know, all of us here in our community at the Real Estate Wealth Lab, like leaning on each other and asking these questions and being open to asking questions. So thank you for those who did, and being curious, but then also leveraging our Real Estate Wealth Lab advisors and our team out there. So thanks, Keith. Go ahead.
Hey, you're welcome. I was glad to be able to do it and get it all put together and give a little bit of shock factor to Vincent when he didn't know exactly what was coming. Yeah, it was fantastic. I love the questions, right? I mean, I work in this calculator a lot, and as we all know, and we know what we know, and we do what we do, and sometimes we take little small things for granted. And it's great when people say, just hold on a second. So what does that exactly mean? Or what does it do? Or what's the impact? And so, I love it.
Yes. Okay. Well, thank you all. I guess we'll take this as our leave, and we're going to see you next Wednesday. I appreciate the waves. I'll see you next Wednesday. We'll see you at the research lab and the market analysis for oh yeah, actually, I'm going to give you a little sneak peek. So what we're doing next week is I've been hearing a lot of individuals on the internet who are actually really, really, really smart, and they are saying, don't buy real estate. I'm like, what? No. So I'm going to demyth what's going on out there and the timing, because you know how, like, in terms of the cycle, we are experiencing a softening. It will be a softening, but because inflation is the outlier, it's actually not going to impact us the same way as one might think. So this is not a normal cycle. So just be mindful of that. So come on out next week and we're going to dive into all of that so that you don't get spooked by the headlines.
Yeah. Awesome. Hey, thank you, Jennifer. You guys, you know what? This being able to do this helps me fulfill my purpose and vision, which is everyone is living a life of abundance. And you know what? My last word is stay calm and mortgage on.
Yeah, I love that. Thank you, everyone. Thank you, Keith, very much.
You're welcome.
Yeah, thank you. See you.